In this video, I'm going to be reviewing one of our trading strategies called the morning gap strategy. This is a day trade short strategy that trades the S&P E-minis on 2-minute candles, and it looks for strength in the morning, such as gap up, and it'll fade the gap up and go short about 4 minutes after the market opens. This is one of our newer trading strategies, and it's traded in all 4 of the portfolios that we currently offer. And so with that in mind, I'll go ahead and go on to the disclaimer. Okay, so first I would like to go over our disclaimer. We are not registered with the CFTC as a commodity trading advisor. We are what's called a third-party developer. We create algorithms and we license them for use on a personal computer through TradeStation, and they can also be auto-executed through NFA registered brokers. Keep in mind that trading futures and options involves substantial risk of loss. These algorithms are really not for everyone. They should be traded with risk capital only, in our opinion. And lastly, the data that we show, unless otherwise noted, is based on hypothetical backtested models, and it does have certain limitations per the disclaimer here. So feel free to read this. You can pause the video and read it more carefully. The last comment I'll make is that the data is for educational purposes only. Again, because we're not registered, we do not control client accounts. And also, I guess I should mention that because we're not registered, the data that we show has not been audited by any government agencies. So just keep all that in mind as we go through the data in this video. We're going to be talking about performance. Again, that's based on hypothetical backtested models. It does have limitations. At times we do mention the live returns on the website or in the video, and when we do, that is from live data and we note it as such. When we do that, just again keep in mind that past performance is not indicative of future results, and again, trading futures does involve risk of loss and is not for everyone. So as I mentioned at the beginning of the presentation, this strategy trades in all 4 of the portfolios that we offer. It's a day trade, meaning it's in and out the same day. It trades the E-mini S&P futures. It can be traded standalone or as part of one of the portfolios that we offer. The big advantage to this algorithm is that it is a day trade, and it's a pretty high probability trade. But what I'd like to do first is just show you this chart of the S&P 500 E-minis, and this is a 2-minute candle chart, and so each one of these candles is 2 minutes. Now, the first thing that we do is we change the session so that it represents the time that the equity market's open, and that's a common thing we do with all of our strategies. We do that because we want to be trading only when the equity market is open, plus potentially another hour until the futures market close at 5 o'clock Eastern. Now, with this chart up here now, there's the strategy has not been added yet. I just wanted to show you that. But what I'm going to do is I'm going to go ahead and enable the strategy so that you can see it populate onto the chart. And so what's happening right now is TradeStation is loading the strategy that's been coded using easy language, and it's calculating right now, and then what it does is it goes in and adds the trade to the chart. So what you're looking at here is a trade that occurred on the 27th of October, and I believe this is the last trade that we've had on this algorithm as of the time of this video. But what you'll see is that if I kind of zoom in here, is that this strategy will get into the trade at 9:34 Eastern. So 4 minutes after the equity market opens is when this trade can be triggered. My experience with day trading algorithms is that it's best to get in towards the open if you can, and then get out at the close. In other words, try to hold the entire day if possible. Now, there's a lot of different ways to trade, to day trade, and a lot of people have other ways and other techniques, and they might disagree with what I've just said. But in all the back testing I've done and all the algorithms I've coded, trying to utilize the entire day is in some ways the easiest way to day trade. If you don't, then what you're usually going to be doing is more of a scalping algorithm where you get in on a candle and then you get out shortly after or even an hour after. But what that requires, at least on the S&P E-minis, is that you have fairly tight targets, and then once you factor in slippage and commission, the average gain on those trades is usually pretty small. And so again, my experience is that it's better to utilize the entire day and hold if possible. And that's not just my opinion, that's what kind of the backtesting shows, at least for the entries that I use. But this strategy, again, is a day trade. It gets in 4 minutes after the market opens, and it gets out at the close, unless it's stopped out, or if it hits its target. So this algorithm does have a target of about $700. So when it gets in, it immediately sends the stop and also the limit order. And I'll try to find a trade where it hit its limit price and one where it hit its stop, so you can see what I mean. But what TradeStation does is it'll add the entry and then a dotted line showing the exit. And if you have this kind of blue colored dotted line, that means it was a winning trade. This trade in particular got in at 2139.5 roughly, got out at 2127.75. So that would be a gain of approximately roughly 12 points on the S&P. So that would have been a $600 gain. So that's, and on if this was trading in the S&P Crusher, on a 30K account, $600 gain would be about a 2% gain on this trade. So what I'll do now is I'll kind of zoom out and show you a few other trades that this one has placed, and then we're going to look at some of the performance reports. So right here is an example of a trade that I don't believe it got stopped out, but it did get out at the close at a loss. So we went short the market right here. We're actually up quite a bit at one point, and then the market rallied and it got out at the close. So what I'd like to do now is I think I'd like to look at the performance reports, and we can walk through some of the stats on this algorithm. And then what I also want to do is show you how we can change the inputs and to show you how that affects the performance reports. Okay, so this chart goes all the way back till May 2003, and it goes forward until October, or actually until November of 2016. Once it adds all the trades, then what TradeStation does is it creates these performance reports that let you look at how the algorithm did, and it's how we judge the quality of the algorithm, on the backtesting at least. So the first thing we look at is the profit factor. This one has a profit factor 1.70, and that's actually pretty good. And what the profit factor is, it's the ratio of total profit, or of gross profit to gross loss. So the higher the better. My experience has been that anything above 2.5 is more than likely the result of over-optimization. Again, other traders might disagree with that, but for me, we look for a sweet spot of between 1.2 and about 2.5. 1.7 is a great profit factor. This one has a total number of trades of 142 in the backtesting. The only negative with this algorithm is that the total number of trades is kind of small. We like to see usually 200 or more. This one we made an exception mainly because it's built on some principles of some other algorithms that we have that do have more trades, and so we did make an exception for it. The average trade net profit is 107, and so that's, if you average in all the winners and all the losers, that's what it does on the backtesting. It has a 57% win rate, meaning just over half the time it's going to be profitable in the backtesting at least. A few other things to look that we look at are the drawdown, and in this one it's about $3,315. And so that's if you're trading one contract, that's the max drawdown that this algorithm has seen since going all the way back to May 2003. This is helpful because it can help guide and tell you kind of how many what a good per unit trade size might be for this algorithm if it was trading alone. We put it at 10,000, meaning that if we took our max drawdown of 3,315 in the backtesting, the account would still have $7,000 and could still trade this algorithm. Because it's a day trade, you really only need, depending on the broker, about $1,000 to trade this, and that's because usually they give you a day trade margin rate of 1/4 of the overnight buying power required for the S&P, which is about $5,000, but that can change. So with this algorithm, though, the other thing I want to look at, so it'll give you the trade list. This shows every trade in the history of the backtesting. It'll also give you periodical returns, and again, this is assuming one contract is being traded. It'll give you the equity curve, and this is always helpful just to kind of see in general how the algorithm does. This point right here is probably that drawdown that it saw of about $3,000. You can see that the most recent trade we had put this on a new account equity high, so that's good. Other than that, though, there's just a ton of data in these reports, but I've kind of shown you the main things that we look at. In the settings section, it just tells you what the algorithm is set to its inputs, and we do hide some of the inputs in the strategy so that they're basically hidden on the TradeStation platform. It gives you the commission that we modeled in, which is 3.25 per share per contract, and that's per trade. So round trip, meaning the buy and the sell, or the sell and the buyback, is $6.50. The slippage we use is one tick, which is one tick round trip, so that's $12.50 per round trip trade. Okay, so now that we've looked at this performance report, what I'd like to do is show you a few of the inputs and how changing those affects this performance report. So with the algorithm loaded, what I can do is and this is actually in some ways how algorithms are developed or modified or new ideas are created. But someone might look at this chart and say, well, you got stopped out, you had a really nice gain. If you would have gotten out on some gain, then you would have prevented yourself from being stopped out, and this would have been a winner, obviously. So what I'm going to do is modify the algorithm a little bit to get out, and I'm going to show you what it does. So we went short at 21.74, and right about in here was 21.68. So if we had a target of 6 points, which would be $300, we would have gotten out of this trade with a win. So what I'm going to do is I'm going to modify the strategy, and I'm going to change the target to $300. So what I want to do is show you how that affects the overall performance of the algorithm. And I'm doing this because we do get a lot of questions when this happens. We'll get emails periodically, and I understand why. Where people they might be frustrated that we were up and then we had a winner turn into a loser. So I'm doing this to kind of show how the reason why we don't kind of chase trades in that way. In other words, we don't based on one or two trades modify the inputs, because what it does is it affects the entire performance of the algorithm. So you can see that by changing the target to $300, we would have gotten out here with a gain. But if you look here, look what it did to our profit factor. It went from 1.7 all the way down to 1.29. It is true that our percent profitable went up by about 5%, and that's to be expected because it will get out more often on a smaller gain. But look at what our average trade net profit is now. It's only $38, where before it was about $100. So if we look at the equity curve, it's also not as good as the other one we had. It looks like the max drawdown was probably about the same, about $3,000. So it didn't affect the drawdown, but it definitely affects the profits that this algorithm would have had. So if I change it back to the normal target, which is $700, then you'll see the profit factor go back to what it should be. And that's just a real basic example of how we create the algorithm. So it's, we don't pick the target just out of thin air. The way we come up with the targets and the stops is we'll actually run an optimization where it'll sweep through all the different combinations of stops and targets and let you know which one is kind of the most ideal. And when we do that, we use a pretty rigid increment, because we don't want it to do it based on a quarter of a point. In other words, we don't want to be as granular as possible, because we don't want to insert the possibility of over-optimization, and we don't want to show back-tested results that we don't think are at least possible in the live trading. But the other thing I want to talk about is when we do these strategies like this, we have about 15 design criteria points that we check off before we officially make an algorithm part of a package and something that we offer to the public. One of those, and I want to give an example here, is we will modify the inputs by plus or minus 10% to make sure it doesn't affect the algorithm too much. So again, the purpose of this is to just do kind of a sanity check and make sure that we're not over-optimized, that everything is not so carefully aligned that any slight difference is going to throw off the entire algorithm. So in this case, if I change the target from $700 to $630, I just want to show you what that does. And so what it's doing is it's recalculating, and you'll see that this trade that we've been looking at still would have gotten stopped out, because this drop here was not enough to hit the $630 target. But if we look at the performance report, this is the equity curve, and you can see that it looks a lot like the first one with the $700 target. It does drop the profit factor a little bit, but not by a lot, so that's considered a pass for us. And what I'll do now is I'll now increase it by 10%. So I'm going to go to Format, and now instead of 700, I'm going to use 770, just to show you how that affects the profit factor. So what it's doing now is it's recalculating with a target of $770, just a 10% increase from what our optimized value was. And again, we would have got stopped out of that trade, and you can see that the profit factor goes from 1.7 to 1.67. So again, just a nudge, like a real small decrease, which is good for us. And again, the equity curve looks about the same, so that's good. And so that's the kind of thing that we do as we develop these algorithms, as we test these strategies. We do everything we can to make sure that we believe that the algorithm will do close to what it does in the back testing. And so I can do the same thing on this open stop distance. And really what this is for the stop, what we do is we take the point of entry and then basically the high of the two previous candles, and then we add 9 points to that. And so that's what our stop is. So it's basically a stop that says if we go above our previous high for the day in the first 4 minutes of trading, plus 9 points, and that's when we want to get out of the trade. So I'm going to modify this to be 10% lower, which would make it 8, just to show you that it doesn't really affect the strategy performance by very much. And again, the reason why we do this is to show that that the algorithm is not it's not like a house of cards where everything is super flimsy and it's all based on some one number being exactly perfect. Because you always want to have kind of built-in margin for error with any trading strategy. And you can see on this one, by changing the stop a little bit, It does drop the profit factor down a little bit more, but it's still a profitable algorithm. It still has a good profit factor, and so this is definitely a passing case for us. And then if I increase it by 1, you'll see what it does. So now if the stop is increased by 1 more point from what, and you know what, I just realized I didn't change the target back to 700, and that's okay because we do cross modifications as well, which I guess that's what that would be, where we change multiple inputs by 10%. Usually what we'll do is we'll try to randomize the inputs, and you're not seeing all the inputs here. We have a few others for some of the technical indicators this uses. But again, the normal inputs are 9 on the stop distance and 700 on the target. So all I'm doing is increasing the stop distance by another point, by 10%, to see what it does to the overall strategy. And you'll see that the strategy, at least this chart again, is going to look the same because it didn't actually hit our stop on this trade. It just naturally got out at the close. But let's see what it does to the profit factor. So in this case it goes from 1.7 to 1.69, so it just barely affects the performance of the algorithm. Okay, so the last thing I'm going to do is I'm just going to change it back to the normal input that it should be and talk about one more thing related to this algorithm. So the other thing that we look at when we develop an algorithm like this is we'll look at what happens if you had a trailing stop. What happens if you, instead of getting out at the end of the day, what if you hold it for a couple days? What if you hold it for 3 days? What if you get out kind of in the middle of the day? You know, we'll do all kinds of different analysis like that to try to figure out if there's a better way to trade the algorithm. And sometimes the algorithm, we will see an improvement, and if that's the case and if it makes sense to add that improvement, we will. But I can tell you is that the way that the algorithm is set up now without a trailing stop is already and getting out at the close and having a limit order target and having a stop that's kind of above the previous 2 candles high. That is the result of all that analysis. And so you know, when I first started looking at this algorithm, it did not look like this. You know, it was I believe originally it was, I wanted to see if you had a gap up above a certain amount, did it make sense to short the market and get out when the gap was filled. And so that's how this algorithm started, but as you develop it, as you write code, as you do the analysis, you start realizing that your initial idea can be improved on greatly. The other thing I'll comment on, and you've probably heard me say this before, but the simpler the better the algorithm, meaning you definitely don't want an algorithm that has, well, I don't want to say definitely, but generally speaking, the more technical indicators an algorithm has, the more things it's looking at, the less likely it is to perform well in live trading. And the reason why, so some people think, well, the more complicated the algorithm, the better, right? Not necessarily, because if you could write an algorithm that had one line of code that said on a 2-minute candle, if you have any down candle, if you buy and get out at the close, that's a profitable algorithm. If that worked, that would be your algorithm. There'd be no need to add more indicators or look at new things or do things any different than that. The same thing applies when you do a trading strategy that might use a technical indicator. So it usually starts with one indicator and maybe one pattern that you're looking at. And if that strategy doesn't work, but it shows some promise, a designer might look at a chart and say, well, you know, maybe something was happening on this point. Let me actually pull up the chart and I'll do kind of a little example here. Let's look at this equity curve again. So right in here from in 08 this is where we had the drawdown. So what could be tempting for someone to do is to look at this period and put some indicator on the chart that might help prevent you from being in this trade right here, or this group of trades that caused that drawdown. And so you'd add the indicator, and then magically this equity curve would improve, this drawdown would go away, maybe it would create another smaller drawdown, maybe a bigger drawdown, who knows. But the point is that the more indicators you add, the more of a house of cards that you're really creating, where it's really not kind of just the raw, this is how this kind of basic strategy does, and it becomes more of a the basic strategy, but then a bunch of asterisks where you're kind of removing bad trades from the trade history just so that you can get a nice equity curve. So that's why pretty much any developer will tell you the same thing, that the fewer the indicators, the better. Now, it doesn't mean that the strategy should have only 10 lines of code or anything like that. I mean, the strategies can still be very, very complicated when it comes to order entry, when it comes to looking for certain patterns. Some of the algorithms that I've written have had, gosh, I think one had 5,000 lines of code. Some of the ones that we trade now have on the order of hundreds of lines of code. So they can still be complicated, especially if you're using state machines and things like that. But generally speaking, the simpler the better. Okay, so with that, what I'd like to do is start looking at some of the performance data on this algorithm. All right, so what I've done is I've pulled up a browser with our website here, and what I want to do is show you how to find more detailed information on this strategy. So all you do is you go to trading strategies. So again, the portfolios are the collection of different trading strategies. The trading strategies are the kind of individual strategies that are traded within the portfolios. So if we go to this morning gap day trading strategy, we'll see the product page for this algorithm. And really all we've done is we've taken the back-tested performance reports, like the one that we were looking at on TradeStation, and we've kind of extracted some of the key data out of those reports so that we can show on the website some of the key things that most people care about. Now again, the per $10,000 traded, that's the $10,000 unit size is really geared towards someone that might only want to trade this strategy for whatever reason. So if that was the case, then we just pick 10,000 as kind of a unit trade size, and that's how we use, or that's the number we use to get our percent gains and to measure the drawdown, those kind of things. So just remember that this strategy alone, the percent gain per year is only 10% on a $10,000 account, which ends up being about $1,000 a year. Now I know that that's a very small number, and something that most traders would have no interest in using an algorithm like this because of that. However, with these day trade algorithms, it doesn't really matter as long as it's profitable and meets the conditions that we look at for a good algorithm. The reason why is because, again, it's geared for a specific market condition, and because this algorithm trades as part of an entire suite of algorithms in one of the portfolios, then it's not like this is all that we do for the entire portfolio. This is just how this one algorithm does in the portfolio. Now, if adding this algorithm required us to increase our per unit trade size on the crusher, as an example, from 30,000 to say 35,000, then adding this algorithm might not make sense. But because it's a day trade, it's essentially free, because day trading the futures, the brokers give a day trading margin rate of usually it's 1/4 of what the overnight margin is, and so it's really free. If whether we trade this algorithm or not in any of our packages, does not really affect the unit size of the portfolio. So it's kind of a free algorithm. So the key is it a good algorithm? Is it profitable? And by the way, a lot of people would be happy with 10% per year. So it's not that it's bad, it's just that as traders we usually want to see something better. The other comment I'll make is that the reason why this is so low is just because it doesn't trade that often. In the roughly 13 years that it was backtested, it only had 142 trades. So that average is only about 10 trades per year, and that's a good thing, because what it shows, I think, is that this algorithm really is only looking for high probability trades. It's not being overly aggressive just for the sake of trading. It only takes the ones that are the high probability ones. Another thing that we add on this sheet that the performance report from TradeStation does not have are things like monthly win rates. We add this so that we can show how the algorithm does over any given month. Now with this algorithm, because it trades only about once a month, it's going to be real close to the actual trade win rate. Some of the other algorithms, though, that might do 5 to 10 trades per month, you'll see that the monthly win rates can be quite a bit higher than the per trade win rate. The last thing I'll talk about here is this part right here. We say trades with $500 loss or more, which is a 5% loss based on the $10,000 account. We add this to our reports because we want to be able to show just in general how risky any given algorithm is. So out of 142 trades, 28 of them had losses that were $500 or more, or about 5%. And so that's only about 20%. And I know the 5% number is actually probably sounds kind of big, but keep in mind when this algorithm is traded in the other packages, like our flagship portfolio, the S&P Crusher, which has a 30K account, a 30K unit trade size, then a $500 loss on a $30,000 account is now just under 2% loss. So that gives you an idea of just the high-level performance metrics backtested of this algorithm. And then we have also the backtesting information. So we list what period this algorithm was optimized through. We also show the commission and slippage used in the reports, and then the worst percent drawdown closing trade to closing trade per 10,000 traded, which is about 27%, and we kind of looked at that on that other report. And then we show when that was seen so that people can get an idea of the duration of the drawdown. Now again, remember that this is a single trading strategy that's used in a portfolio, and so a lot of this data is really just looking under the hood of the portfolios that we offer, so that you can see how each algorithm in the portfolio contributes to that portfolio. Okay, so then right here we just have the just another view of what this algorithm is. So that it's the gap short algorithm. It trades the E-mini S&P. Some of this is kind of repeated from what we already looked at. It outperforms in rebounding and down markets, and then it does not have the ability to hold overnight. It's a day trade. And again, that's good to know, because it just shows that this algorithm is a lower risk one. Because it's in and out the same day, we don't carry any overnight risk of market collapsing overseas or some geopolitical event that would rattle the markets. Or since this is a short algorithm, I guess it'd be kind of the opposite, where I don't know, some monetary policy changes and the market gaps up 500 points. Because it's in and out the same day, we don't have to worry about the overnight risk. It's not to say that there's no risk involved, because futures is always involves risk. Even though we have stops during the day, we always have to say that just because we have stops doesn't mean that the stops are gonna trigger appropriately. Now with auto execution brokers, they are watching those, and so the likelihood of those kind of things happening are very low, but it always is a possibility. But having said all that, day trading algorithms are generally considered lower risk because they don't hold overnight and over the weekend. So the type of algorithm, this is a gap fade short algorithm. It's also kind of a momentum algorithm in that it's looking at a gap, it's fading the gap, and then it's expecting the gap to sell off pretty quickly, and so it's momentum. It's a momentum biased as opposed to like a trend algorithm that might be looking primarily at a trend and be taking a longer term approach. This tab just shows the minimum account size. So if somebody wanted to trade this algorithm alone with the auto execution broker, the broker would want to see about 10,000 in the account. The reality is you could probably trade this one with as little as 5,000. But the problem with doing a lower amount is then if you have that drawdown, then you might not be able to continue trading. Okay, so this one it just trades one algorithm. It's the gap short. It trades the ES. It trades futures. It does not trade options, and someone can trade cash IRA, Roth IRA in this account. Let me keep scrolling down now. So what this shows is this just shows the monthly PL based on the year. So you can kind of go through this and see the monthly PL based on each year. The next thing I'll show is the trade list. So at the end of every day, we update this trade list to reflect the most recent trades. One thing you might notice is that on this trade right here, the slippage is listed as 0, and that's because as trades develop in this package and we start doing as we start seeing more live trades, then we start using the actual live fills from the trading accounts as opposed to the hypothetical. We still list this as backtested hypothetical because we have to show, the kind of the lowest common denominator, which is backtested. But just keep in mind, if you see the slippage is 0 on some of these reports, it's because we took it from the actual broker statement that we received. And so this is the last trade that we had. I think it's the one we're actually looking at, where we went short at 21.40 and we covered at 2127.75. We still have commission though of $6.50, and this just rounds to 7. The PL on that trade was $606, and then this just shows our hypothetical account if someone started trading this from back in 2003. Then the last thing is we do have the performance report listed here so that you can download it and look at it if you'd like. Alright, so the last thing I want to do when talking about this morning gap strategy is to talk about how it does based on what the S&P does for any given month. And again, if you've seen our other videos, you're probably familiar with this kind of presentation of performance. And in particular, if you watch our design methodology video, we talk in quite a bit of detail about what all this means. But essentially, all it means is it's a way of us characterizing how any one of our algorithms does based on what the S&P is doing. And as you know, our methodology is based on having multiple uncorrelated algorithms that do good in different market conditions. Now, it'd be great if we had one algorithm that just did amazing and up, sideways, and also down. Our experience is that in order to get an algorithm that looks like that on the backtesting, you have to sacrifice a lot of other things, like I talked about before when we were talking about over-optimizing, where you have to go in and say, well, how do I get rid of this down, or in this case, this up 23? How do we make that 150? And so you go in and you modify the algorithm, you add indicators to kind of optimize away this. I don't believe that's a good way to do algorithmic trading. So we focus on what's the algorithm's strength, and in this case it's a down market and also sideways moving market, and its weakness is an up moving market. So that's okay as long as we as part of a portfolio we have some algorithms that do good in up moving markets, and then those algorithms don't lose a lot in down moving markets. Now if someone is just trading this algorithm alone, then this would be a concern, is that if the market is moving higher, it's going to be basically break even. Some months it'll have gains, some months losses, but the average will be losing or break even trades. So that's why, generally speaking, we don't recommend people trade any of our strategies as kind of their own strategy, and why we always think of our product as being a portfolio. But again, we're looking under the hood. So this strategy does well in down moving markets and also sideways moving markets, and so that's kind of how it fits into the grand scheme of the portfolios that we offer. The reason why we offer this strategy in all 4 of our portfolios, and we'll probably offer it in any portfolio we offer, is again because it's a low risk trade. It doesn't require any extra margin, and so it's almost like, why not add it? If it's going to potentially help out in down moving markets and sideways, why not add it? I think that's all I have to say about this slide, and so that's kind of the end of this presentation on the morning gap algorithm. I hope it was helpful. I hope it was insightful. For those of you that are trading any of our portfolios, this algorithm is currently being traded, and we look forward to its continued success, hopefully. Keep in mind, as always, that trading futures and options, it does involve substantial risk of loss. It's not appropriate for all investors. The data that I had talked about, these numbers, it's based on back-tested models, which have significant limitations per the CFTC disclaimer. This algorithm, being one of our newer ones, has really only traded live for about a month now, and so it is a newer algorithm, but it is based on our original breakout and short algorithm, and just kind of looking at those algorithms and seeing if there's any other patterns that emerge out of them. That's one reason why we decided to offer it live with only having about a month of live trades in it, is because we've kind of seen it trade live kind of on a walk forward basis for about a year, actually more really. And so we have a high degree of confidence in this algorithm. We think that it will help take advantage of some inefficiencies that happen when the market gaps higher and then sells off a little bit. I think that's all I have to say. So look forward to talking to you again about some of the other strategies that we have, or the portfolios. And thanks a ton for reaching out to us, or for watching the video. If you want a live demo, feel free to email us at sales@AlgorithmicTrading.net, or you can give us a call, and we'd be happy to set up a live demo where we can walk you through some of the trades, answer any questions you have, and talk to you about pricing as well for the portfolios that we offer. Have a great day. Bye-bye.